So the next is audit of revenue. So revenue is under the standard called as IFRS 15, revenue from contracts with customers. Now as per IFRS 15, there is a 5-step model for recognizing revenue. Step 1 is to identify the contract with the customer. Step 2 is identify the performance obligations in a contract. Step 3, determine the transaction price. Step 4, allocate the transaction price to the performance obligation. And step 5, recognize revenue as the entity satisfies a performance obligation. So only if these 5 steps model have been completed, they can recognize revenue. So the concept here is to ensure that the performance obligation is satisfied. So what is this performance obligation? Performance obligation is a promise in a contract. So an example of a performance obligation is, let us say for example, you went to a restaurant. So let us say A went to restaurant. Okay. Now, if the restaurant wants to, classify, A's payment of bill. Let's say A paid around $10, okay, for food. Now, if this restaurant wants to classify this $10 as a revenue, then the restaurant should have satisfied the performance obligation. What is the performance obligation for the restaurant? The performance obligation will be the serving of the food as well as providing the service. So only if the necessary food as well as the service have been provided to A, then the restaurant can claim a performance obligation. This is one example. So here the performance obligation is satisfied at the point in time itself. Like you're going to a restaurant, A is going to the restaurant, he's sitting there and the restaurant is serving him food. And for the food he has charged, now A has to pay the bill. So the food he has served, A has to pay the bill to the restaurant. The moment the A pays the bill, the restaurant can satisfy the performance obligation. If A did not pay the bill, he said that, oh, you know what, I will pay you tomorrow, then restaurant can charge revenue, but it will be a receivable. So if A said that, you know what, I will pay you tomorrow, then restaurant will show as a receivable. The second example is where, let's say the same A ordered from Amazon. So ordered from Amazon. Okay. Let us say the same A, instead of going to a restaurant and eating, let us say he ordered from, let us say a food delivery app called as Zomato. So he ordered food from Zomato. Now, when we are ordering food from Zomato, what we would do? A would have paid first. So paid first. Now, when can Zomato recognize the revenue? So let's say he ordered for the same bill of $10. So this is the bill amount. Now when can Zomato recognize for the revenue? When can he recognize for the revenue? Not when he has paid. Only when Zomato have delivered. So what if instead of delivering to A, Zomato delivered to another guy called Z and he ate the food? Can Zomato claim the revenue? No, he cannot. Because he has delivered incorrectly to someone else. Contract between A and Zomato have not been fulfilled. So there Zomato, even though they have delivered the food from their part, they have not delivered it to the right person. So the contract between A and Zomato is not fulfilled. The performance obligation is not satisfied. So only when Zomato have delivered the food, to A, and when he delivers the food to A, only then Zomato can recognize the revenue. So here what happens is that recognition of revenue becomes always a problem. Why? To give you a simple example, we all order items from Amazon. What does Amazon gives you? A 30-day return policy. Right? So what is the problem with that? If Amazon gives you a 30-day return policy, let's look at here what's the situation. So let us say that A, okay, ordered from Amazon. Okay, let us say A ordered an iPhone. So he ordered an iPhone. Okay, now within 2 days, A delivered this iPhone to 2 days, delivered to A. Okay. So A has received the iPhone in 2 days. So immediately A paid the amount to Amazon. So they paid the amount to Amazon. So let us say the ordering date was on 1st January 2021. Okay, 1st January 2021. So they delivered the iPhone in 2 days. So which means on 3rd January 2021, the iPhone was delivered and it has been paid for. Now, there is a criteria that Amazon has a 30-day refund policy. So 30-day refund policy. 30-day refund from date of delivery. Date of delivery. Okay. From the date of delivery, there is a 30-day refund policy. Now, Amazon wants to recognize this revenue. Right? They have delivered the product. So, have they satisfied the performance obligation? Yes. Has the performance obligation been satisfied? Obligation satisfied? Satisfied? Yes. On when did this satisfy? On 3rd January 2021. But there is a problem. What is a problem? The contract explains something else. If you order product from Amazon, within 30 days you can refund. So the customer A, maybe he might use it for 5 days and when he say that, you know what, I don't want this iPhone, take it back. That's a problem, right? So so this will become a problem. So Amazon have to wait. So Amazon have to wait till this 30 days are over. 30 days are over to recognize revenue. Price revenue. So which means Amazon can recognize revenue. Amazon can recognize revenue on which date? Not on 3rd January, but on 3rd February 2021. Only after 30 to 31 days he can recognize revenue. So till then what do you do? So the product was ordered on 1st January 2021. This was the order date ordered. Right? It was delivered on 3rd January 2021 and paid. So delivered and paid. So delivered and paid. Okay. It was delivered and paid on 3rd January 2021. But Amazon can recognize revenue only after 30 days. Let's say I would put it as 2nd of February 2021. This is when revenue can be recognized. But however, the double entry won't work, right? Why? Because on 3rd it has been paid. So if cash is being debited on 3rd January, what will happen? Okay, 3rd January 2021, Amazon will receive cash, right? On 3rd January 2021, in the books of Amazon, what will happen? Amazon will receive cash, debit cash for the iPhone. Let us say it is $1,000. Okay, debit cash. What will he credit? Supposedly he should have credited revenue, but it's not allowed as per the standard. IFRS 15 says that you cannot recognize revenue until the refund period is over. So what will you classify it as? What will you classify it as? So you have to create a refund liability. Why? So you will create a refund liability. So to the extent of $1,000, because the same amount can be refunded back. So if the person comes and buys a product, okay, and he can return the money, he will expect to give back the money, right? He'll expect to give back the money. At the same time, he has given the product, right? On 3rd January, this guy has given the product. Where is the inventory? Is there an inventory? No, there is no inventory. Inventory has also gone to A. So the inventory has gone to A. So the iPhone is with A. So if you check the warehouse of Amazon on 3rd January, You will not get the iPhone because the iPhone has been delivered to A. It is now with A. So if A is going to refund the product before 30 days, then Amazon have to pay back the cash, right? But at the same time, if A is going to refund the product, Amazon have the right to get the products back. So on 3rd January, there will be another entry that will be posted, which is called as a right of return of product. So what you will do, you will debit the right of return of the product, okay, and credit the inventory, but to the extent of only the cost. The profit will not be categorized. So let's say, assume the cost is 800,000. So only the cost of inventory will be moved. Why? Because inventory are held at cost. Only revenue minus cost will be the gross profit, right? Inventory of iPhone, which is held at cost. So that inventory was sold to A. So on 3rd January, it has been in the books of A. Now it's moved from Amazon to A. But Amazon can get that back within 30 days. So you will increase the right of return, which is as asset, but inventory is not there because inventory has gone out. So that will become 800, right? Now, after 1 month, which is on 2nd February 2021, after 30 days. So after 30 days is over, what can you do? After 30 days is over, you can recognize revenue. How will you recognize the revenue? You will debit the refund liability. Debit refund liability with respect to $1,000 and credit revenue with respect to $1,000. Same way, you will post another entry for your inventory. What is that? Inventory has been already credited, right? So why you need to worry about that? So what will you do? You will debit cost of sales with respect to 800 and credit the right of return of asset. So right of return of asset, you will credit of 800. So this entry will be gone, and this entry will also be removed. This and this will be removed. But this one, which is the cash and the inventory, are true entries on 3rd January itself because they have happened. You have received the cash and the inventory have been gone. You got the money and you have given the iPhone to the customer. But within 30 days, he has the right to receive. So which means you will create a corresponding refund liability and the right of return of asset. This is what the IFRS 15 says. So here, what could go wrong? What is the risk? What if the Amazon does not follow this model? Rather, on 3rd January itself, they categorize the revenue. So what will happen? Your revenue will be overstated on the month of January. So the risk is that, so here the risk, which is your what could go wrong with the accounting treatment, is that Amazon could overstate the revenue whereby recognizing it on 3rd January 2021 instead of 2nd February 2021 when the refund days are over, when the refund period is over. So only when the refund period is over, they are supposed to recognize revenue. But what if they recognize it on 3rd January itself, the moment they satisfy the performance application? That is incorrect. So you need to be very careful, because that's why revenue is considered to be a significant risk and potential for a possibility for a fraud risk as well. Because overstatement of revenue, specifically in the current situation where we are dealing with a lot of startup, all these startup entities, what they are doing is very simple: overstating their revenue. Because all their investors, they want to show big money that they have made this much revenue. So they are unnecessarily boosting the revenue, which is not correct. Okay, so this is a problem, and these kind of problems could happen in industries like service industries, like teaching companies, coaching institutions, where you buy a lesson. Let's say for example, V-Guide itself. You buy a class from us. The class could a course from us. It could go for a period of 6 months, 3 months to 1 year. So if you buy a 3-month course, then we can recognize revenue only if we have satisfied the performance obligation, which means after the 3-month period is over, right? But what if we buy a course of for 1 year period? Then only after 1 year we can recognize the revenue. Till then, if you have made the payment, it's a liability for us. It's a liability for us because we are supposed to give the course now. So you need to be very clear when the revenue can be recognized. Similarly, construction industries, they could have accelerated revenues. Revenue is based on the performance obligation satisfied. How much construction have been completed. Only based on that, revenue can be recognized. So it's all very important that you need to follow. Okay, that's all you need to understand. So let's look at an activity here and try to understand, the solution. You are an audit senior of Audit of Lakshman Co., a wholesale seller of statutory and office products. So these are a wholesale seller. So which means they sell it to retailers. So if you are a wholesaler itself, first thing risk that should come to your mind is receivables. Okay, receivables. Receivables could be very high. Okay, and also when you are selling it to retailers, there will be certain conditions, criteria, conditions, etc. So all of those things you need to follow. Recognized within revenue are a series of credit sales of inventory totaling 200,000 that took place close to the year end. Lakshman continues to hold the legal title to this inventory. So we sold the revenue products, but you still have the legal title. So how can you say that, revenue is classified or revenue is recognized? Revenue is not recognized when the company still holds title. Only when the transfer of title is being completed, right? The control has been transferred, which is the satisfaction of performance obligation. Revenue can be satisfied. Revenue can be recognized. So not just transfer of title, like just the ownership document you give it. No, not just that. But the legal possession of the goods should also be transferred. The control should be passed from the seller to the buyer. Only then the seller can recognize revenue. Lakshman holds a bank loan whose covenants impose on it a number of conditions, one which is that the financial statement should show an asset test ratio of more than 1. The following amounts are shown in the draft financial statements. Revenue of 1.2 million, current assets of 1 million, inventory of 100,000, current liabilities of 800,000. Identify and explain the principal matters to consider when auditing the revenue of Lakshman Company. So here, if we look at the first one, that is the inventory. Now, what is the issue here? Now, IFRS 15, as per IFRS 15, revenue can be recognized. So revenue is recognized when the performance obligation is satisfied. So only when the performance obligation is satisfied, then revenue can be recognized. But here the legal title, the legal transfer of title has not yet occurred. So the legal transfer of title has not yet occurred. So revenue should not be recognized in that case. So should not be recognized. However, there is a criteria that IFRS 15 says that legal title is not sufficient evidence, but transfer of control is what is more evidence. So as per IFRS 15, it says that mere transfer of title transfer of title is not sufficient evidence. However, transfer of control or performance obligation should be satisfied to recognize revenue. Satisfied to recognize revenue. So in this case, we need to obtain further evidence. So there could be situation that, okay, the title has not been transferred because maybe the retailer, Lakshman and Co is worried that the retailer might not pay. So if there is a non-payment of receivable, so they will be that will become an issue. So here that could be one of the instance. So hence what we need to write is we need to obtain additional evidence. So title could be retained for protection against non-payment of receivable. That could be the situation. Okay, that could be the situation, right? So hence further evidence should be obtained to form a judgment which is a substance over the transactions, over the legal form. Judgment to verify the IFRS 15 condition. That's the number one situation here. Okay. So that's what we are talking about when it comes to IFRS 15 for the revenue recognition, where for a specific title of amount of 200,000, whether the revenue should be recognized or not. Now second is relating to the loan. So loan has a covenant. So there is a covenant of asset test to be maintained over 1. So what is asset test? Current asset minus inventory by current liability. So what is a current asset test? So current asset test, okay, current asset test, if you look at here, current assets is 1 million minus the inventory. So $1 million minus 100,000 divided by current liability, which is 800,000. So that is $800,000. So the asset test is coming to around 1.125. So which means it is within the criteria. So asset test should be over 1. So which means this is within the criteria. But there is a problem. What is the problem? Now, situation of the inventory with respect to inventory / revenue with respect to $200,000, which was discussed in point number 1 above. So what is the situation here? Whether this particular revenue can be classified or not. So if as per IFRS 15, this revenue cannot be classified, if you have obtained further evidence and as per IFRS 15 the revenue cannot be classified, then receivable will decrease and inventory will increase. Okay, which will increase the inventory and decrease the receivable. But it will not affect the current assets, but liquid assets, acid test, it would affect. So if for above 0.1 revenue cannot be recognized, then receivable will reduce and inventory will increase, because we need to remove the receivable and increase the inventories. Revenue will be reversed. So debit revenue and credit receivables will have to be done. So in this case, what will happen? Our inventory will increase. So from 100,000, we need to increase our inventory to 300,000. So the new asset test ratio, so the new, or I would put it as revised. So the revised asset test will be $1 million minus $300,000 whole divided by $800,000, which will be 0.875, which is lower than the conditions. So this could be a big issue. Here, this particular transaction, now 200,000, will be a significant risk. So now this will become firstly a significant risk, because it affects not only revenue, but also it affects the other area of loan. So if the loan is repaid, if the loan have to be repaid, then what will happen? Then it could affect the going concern ability. So the going concern capability could be affected. So that have to be clearly revisited. There is also, apart from this, possibility of fraud. So because they know that the asset test ratio have to be maintained, there could be deliberate intentions by the management. To overstate receivables and understate inventory. So that, they could have somehow come up with a deal with their retailers, saying that, you know what, take away few of my inventories, keep it with you. Okay, I will take, do one thing. I will show a, credit note. I'll show a revenue invoice against your name. Will show as a receivable. After some time, you give back the money and I will show it as a credit note. So as of the year end, we will still have a better asset test ratio. Why? Because receivable will be high, inventory will be low, asset test will be maintained. Not correct. So that's a deliberate intention to represent faultly this criteria. So in the first point, management would have done it deliberately, where they have maintained the legal title somehow. Even though they have classified as a revenue, they have maintained the legal title, because if they come up with the, tied up with the retailer to do this, what if the retailer cheats him? So somehow he wants the product back, right? So to ensure that he gets the product back, he would have maintained the legal title. So the intention should also be questioned, because the inventory that he has sold, the legal title has not transferred. There is a direct relationship now to the acid test ratio, which could impact the Lakshman's ability to continue as a going concern, because of the loan could be breached, and there could be negative consequences like a fine, or the loan, they have to repay the loan, and they might not have money to repay. So all those things could be, that could question the capability of the company to carry on as a going concern. So it becomes a significant risk for the company.